Ladies and gentlemen, good day and welcome to the SBI Life Insurance Company Q4 results call for the financial year ending 31st March 2022. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mahesh Kumar Sharma, Managing Director and CEO, SBI Life Insurance. Thank you, and over to you, sir.
Yeah, thank you very much. Good evening, everyone, and we heartily welcome you all to the annual results update call of SBI Life Insurance for the year ended March 31, 2022. We hope you and your families are safe and well. Update on our financial results can be accessed on our website as well as on the website of both the stock exchanges. So along with me on this call, I have Sangramjit Sarangi, President and CFO, Ravi Krishnamurthy, President Operations and IT, Abhijit Gulanikar, President Business Strategy, Shubhendu Bal, Chief Actuary and CRO, Pritesh Chaubey, Appointed Actuary, and Smita Verma, SVP Finance and Investor Relations. We are pleased to inform you that we have successfully maintained the new business thrust and have again delivered enduring performance in this year as well. This demonstrates the company's strength of distribution and expansive outreach to customers in cost-efficient manner. Our commitment is to deliver sustainable long-term returns to the stakeholders. This would not have been possible without the efforts of all our employees, distribution partners, and business associates for their uninterrupted support, which helped to service our customers during this challenging environment. As mentioned in last earnings call, we have aligned our value of new business, UNB margin, and Indian embedded value as per industry standards, and reported figures will be comparable with peer companies. Now let me give some key highlights for this year ended 31st March 2022. New business premium is at 254.6 billion with a growth of 23% over the previous year. Individual new business premium stands at 165 billion, a strong growth of 32%. Gross written premium stands at 587.6 billion with a growth of 17%. Protection new business premium grew by 24% to 30.5 billion. Individual protection new business premium grew by 26% over previous year to 9.4 billion. Annuity business stands at 34.7 billion, registering a growth of 15% over the previous year. Profit after tax stands at 15.1 billion. Value of new business is 37 billion, registering a strong growth of 39% over the previous year, and the new business margin is at 25.9% with an improvement of 270 basis points. Indian embedded value stands at 396.3 billion. Embedded value operating profit stands at 68.9 billion. Operating return on embedded value stands at 20.6%. Assets under management grew by 21% to 2,674.1 billion. Let me update you on each of these elements in detail. We'll start with the premium. Individual business, one of the focus areas of the company, has grown by 165 billion, a growth of 32%. It has grown to 165 billion, growth of 32%. Single premium contribution is 24% of the individual new business premium, which is mainly attributed to growth in individual annuity product. The company gained the private market share by 166 basis points to 23.4%. Individual rated new business premium stands at 128.7 billion, a growth of 26%, which is leading to private market leadership with a share of 23.4%, an improvement of 75 basis points over previous year. Maintaining private market leadership position in new business premium, we collected 254.6 billion new business premium and private market share of 22%. Group new business premium stands at 89.6 billion with a growth of 10%. Renewal premium grew by 12% to 333 billion, which accounts for 57% of the GWP. Our gross written premium stands at 587.6 billion with a growth of 17%. Total APE stands at 143 billion registering a growth of 25%. Out of this, individual APE stands at 129.6 billion with a growth of 26%. During the year ended 31st March 2022, total 19.2 lakh new policies were issued and registered a growth of 16%. Sum assured under individual products registered growth of 16% over the previous year as compared to the growth of 3% at private industry level. Now about the product mix, individual protection is at 9.4 billion, registering a growth of 26%. Group protection stands at 21.1 billion with a growth of 23%. Credit life new business premium has grown 21% and stands at 16.8 billion. On APE basis, protection contributes 11% of new business and registered a growth of 28%. We are confident that over a period we will be able to register an uptick in share of individual pure protection. Annuity business is at 34.7 billion and contributes 14% of new business premium. Total annuity and pension underwritten by the company is 72.3 billion, registering a growth of 15% over the previous year ended 31st March 2021. Guaranteed non-par savings product is contributing 10% of individual new business, and on total APE basis this contributes 12%. Non-par guaranteed product new business has registered a growth of 62% over the previous year. Individual ULIP business is at 113.2 billion, which constitutes 69% of the individual new business premium and has shown a growth of 32%. Fund management business is at 51.5 billion with a growth of 13%. During the year, the company has launched SBI Life Smart Platina Plus, which provides security, flexibility and reliability through a regular guaranteed long-term income, flexibility to suit life goals and financial protection along with tax benefits. The response to this product is very positive and received record inflows in very short period of time. The company offers comprehensive suite of participating, non-participating, guaranteed, annuity, pension and unit-linked solutions which are designed to enable our customers live life to the fullest across a wide demographic range and income levels. Now a look at the distribution partners. With strength of more than 53,000 CIFs, bank assurance business marks a share of 65% and grew by 31% in individual new business premium. Bank assurance channel individual APE stands at 87.4 billion with a growth of 27%. Agency, our strongest channel registered, our strongest channel after banca, registered new business premium growth of 30% and contributes 18% in new business premium. Agency channel individual APE stands at 36.8 billion with a growth of 22%. As on March 31, 2022, the number of agents stands at 1,46,057. There is improvement of 21% in agents' productivity levels as compared to previous year, and greater use of technology is assisting in better engagement in the entire value chain for recruitment and training through to lead generation, sale and customer service. During the year, other channels, that is direct corporate agents, brokers, online web aggregators, etc., grew by 61% in terms of individual new business premium and 45% in individual APE. Protection new business premium through other channels registered a growth of 41%. Partnerships like Indian Bank, UCO Bank, South Indian Bank, Punjab and Sindh Bank and Yes Bank registered a growth of 49% overall. These relationships contribute almost 4% of individual APE as on March 22. Now on profitability during the year, COVID claims net of reinsurance paid as well as outstanding stands at 15.9 billion, covering various lines of businesses. The company has kept additional reserve amounting to 2.9 billion for COVID-19 pandemic over and above the policy liabilities. The company's PAT for the year ended 31 March 2022 stands at 15.1 billion. Our solvency remains strong at 205% as on March 31, 2022. Value of new business is 37 billion with a growth of 39% over the previous year. New business margin is at 25.9% with an improvement of 270 basis points. Embedded value stands at 396.3 billion with a growth of 8.9% over the previous year. Embedded value operating profit stands at 68.9 billion. Operating return on embedded value is 20.6%. On operational efficiency, cost efficiencies continue to be maintained with total cost ratio at 8.8% and OpEx ratio at 5.1% for the year ended 31st March 2022. 13-month persistency ratio of all policies, that is regular as well as single and limited premium, stands at 88.4% as compared to 87.9% of previous year. In accordance with recent regulatory requirement with respect to persistency of individual regular premium and limited premium paying policy, 13-month persistency stands at 85.2%. Company has registered a strong growth in 25th month and 49-month persistency by 221 basis points and 423 basis points respectively. As mentioned in my opening remarks, assets under management stands at 2.6 trillion as on March 31, 2022, having grown 21% compared to last March. The company continues efficient use of technology for simplification of processes, with 99% of the individual proposals being submitted digitally. 44% of individual proposals are processed through automated underwriting. Customer satisfaction is a key focus area. Grievances ratio, that is number of grievances per 10,000 new business policies, is 16, and grievances with respect to unfair trade practice stands at 0.07%, one of the lowest in the industry. Individual death claim settlement ratio stands at 97%. The macro drivers for the life insurance sector remain well in place. The vision of the regulator for enhancing the insurance penetration and development of the sector is crystal clear and very positive for the industry growth. We strongly believe that our wide distribution network, along with customer-centric product portfolio, are well positioned to capitalize on the emerging opportunities in order to increase the insurance penetration in line with the vision of the regulator. These opportunities include an expanding and prospering middle class, significantly high underpenetration of life insurance in India, a favorable regulatory environment, rapid digitalization, among others. To conclude, we will continue to focus on long-term sustainable profitable growth. Enhanced automation and digitalization will ensure customer satisfaction in the long run, along with great value to all our stakeholders. Thank you very much, and we are now happy to take any questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit the question to 1 per participant. If time permits, you may join the queue for any follow-up. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepika Mundra from JP Morgan. Please go ahead.
Thank you. Good, sir, and thanks for taking my question. So just first and foremost on the effective tax rate change, it seems that if you compare the VNB last year based on effective tax rate, fourth quarter seems flattish at about 11 billion, whereas on the old methodology there seems to be a substantial increase. Can you just describe the differences between the rate of change on the old versus the new methodology?
See, as we mentioned earlier, we used to compute our VNB based on the actual tax basis, and we used to show a sensitivity and effective base. Now, as we mentioned earlier, we have aligned that, and we have aligned in the term of to reflect our actual current financial and taxable position and future in our projection. So to that basis, we have aligned that. Now, if your question is compared to the last quarter VNB, it's a flattish, not because of any change in the methodology. It's a flattish because of the business mix and what kind of product we issued this quarter versus last year's last quarter. So you see that we have made certain measure in the last time in repricing term. This quarter in August we have repriced some of the product where our objective is to get the VNB number rather than getting the margin, and some of the benefit we have passed on to the customer. As a result, we see the VNB flattish.
Now, just to tell Deepika, what we need to see is that our growth, business growth is 4% for the quarter. Last quarter, as you are aware, has been slightly subdued for us. And second thing, taking the year VNB and subtracting 9 months is not strictly correct, because year-end we change our assumptions and so many other parameters. So I wouldn't want to call, that 1% growth as strictly speaking comparable number, because the December numbers have been valued on a slightly different basis than March numbers.
On the EV sensitivity, again, the EV sensitivity to interest rates seems to have come down from half-year levels. Can you just walk us through the change that has taken place over there?
No, if you see the Deepika, for EV sensitivity for interest rate, we disclosed the last year on the financial year basis. As you know, we are writing non-par part, and we have done a lot of forward rate agreement as well. So FRA is helping us to reduce the interest rate sensitivity. Purpose of writing the FRA, and particularly with the guaranteed product, is to immunize your economic balance sheet in terms of the interest rate sensitive movement, and that's really playing out.
Thank you. Mr. Mundra, requested to join the queue for any follow-up. We'll take our next question, that is from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, a couple of questions. One is like if you can comment on the earnings growth, which for this quarter has been quite strong, probably due to lower strain. So some color on this, and how are we looking the shareholder earnings to grow over the coming fiscal?
Yeah, so the profit growth basically, if you look at the growth of our overall business, you will find that there is a very strong growth. So that is one of the things. And in any case, in the last quarter, we always have, a boost because of our, the policyholders' share of our the par product. So shareholders' share of the par product. So that is generally taken in the last quarter. So there is always a strong last quarter. And plus, we have done a huge amount of business, and in various products we have done. So, as a result of that, there is a strong growth.
Okay. And so second question is around the AP growth. While you explained on the VNB that we need to look at the full year number, but if I just look at the AP for 4Q, it is like down 10% on a quarter-on-quarter. And of course the base effect is there, which has dragged this growth. But now again in FY23, the base will remain high for the coming quarters. So will the growth trends likely pick up in the coming year, or will it again be a back-ended growth? So,
see, it will grow. What I am saying is that I don't really think we track the AP so much as the IRP growth. So, and the total business growth. So basically, we will grow. And if you look at the trend throughout, in January and February, there was a fresh wave due to which there were some lockdowns, etc. And that has actually affected our performance a little bit. March, we have started coming back. If you see March, we have grown. So overall, if you see, the trends are very encouraging. In having all these problems, like for example, we had hardly started business this year when there were stringent lockdowns in May, etc. And then again in January, February. So having faced all those problems, we have come out with a 25% growth in APE. So, I think that itself shows that our strength. And this is on the back of a very good base last year also. If you look at last year, our base was not very small. We had grown over the previous year with a very bad COVID year. So taking all that into consideration, we are poised to grow.
Sure, sir. Thank you so much.
Thank you. Our next question is from the line of Adarsh Parasrampuria from CLSA. Please go ahead.
Yes, sir. Congrats on good numbers. Couple of questions, if you can just walk us through the EV changes, right? So your EV has moved, and there is a like-to-like adjustment, which is why you show a 9% growth. Can you walk through the adjustment, because the EV that you've shown in the chart moves from 33,000 crores to that 39,600, and then you show a 9% EV growth. I think that's the adjustment that's there for the change. So if you can just walk us through the difference between the two.
Yeah, I think, what you need to do probably, look at the annexure. Do you have the presentation? This is
Slide number 32.
Slide number 32, no? Yeah. Slide number 32, if you see, the whole breakup is given very nicely. Just go to that. And if you will see, the opening EV is given, and then, each and every element is given. And in that, if you see, we have given the operating experience variances, others.
Yes, sir.
So that is where you'll find the change in our what you call it, the methodology has been taken into account. So taking that into account, you'll see you have the entire picture there.
So basically, the EV impact of that is about 1,200 crores positive.
Not all of it.
Not all, because there are certain other changes in the methodology, others, but predominantly it's a tax benefit. But there are some of other, and there will be some offsetting impact as well.
Got it. And got it. So just wanted to check. We've been running fairly large variances on the positive side for a few years now. So what's our view about that? Last year 450 crores, this year persistency and expenses about 320, and then there would be some sitting in others as well. So what's our view? Do you want to keep maintaining this, or would you kind of change assumptions at some point to get it in VNB?
So just see, others, like we always maintain our position that when we set our assumption is set in line with that in long term, its assumption should be sustainable. So we don't make frequent changes unless evidence. And that's the reason if you look into our all operating variances is coming positive. Last year we have taken some measures in terms of, though we are not made the significant mortality losses, but we strengthen the mortality. Our objective is to ensure that what number we are disclosing and what we are looking into, that should remain sustainable in the future. To that aspect, we are continuous getting these surpluses. If you look into the mortality as well in COVID scenarios, if you exclude this COVID claims, we are having a positive mortality variance. So we continue to do that. And at the same time, we will also keep mentioning that each year we revisit our assumptions, and as and when required, we will refine that way. But we do expect our operating variance will continue to be grow from the current level.
And sir, slide 12, right? Just a follow up on the EV. The heading says EV grew by 9% from 364, and the chart has 333. I was asking, can you explain this 3,000 crore gap?
Yeah. So others, if you see, we used to report one number on actual tax basis, and for the comparative purposes, we give the sensitivity as effective tax rate. Now we found that effective tax rate is no longer relevant, and we moved that. So just to give a comparable to you and all others, that because earlier our walk on the EV was on base-to-base basis. So that's the reason we started on that basis, so that you can look into each and every component. It's easier to comparable with the previous year.
I understand, sir. My only question was, like you showed me in that slide 30 something, that the impact of the accounting change was about that 1,200 crore. It was within that 1,200 crore number, and the opening EV gap between the two accounting methodologies is about 3,000 crores. So I'm not able to add up these numbers.
No. So others, what's happened that we need to reflect as a sensitivity. Now we look into this methodology, we do that, and we consider our current taxation position. We also consider the future tax position of the company, and we have appropriately modeled that, and that's the reason coming from. And secondly, that your business mix sometimes will keep changing from that, and to that extent, you might be seeing some not like-to-like comparison that you can look into the opening difference between waste effect and this. Because there is some other, and what I mentioned earlier as well, there is some other adjustment also done in terms of refinement of the methodology. So there are some offsetting impact. So that number that I'm referring to, that not only on account of taxation. So that's the reason you are not able to like-to-like comparable.
Got it, sir, and thanks. This was it. All the best.
Yeah,
Thank you. Thank you.
Thank you. The next question is from the line of Arav Sangai from VT Capital. Please go ahead.
Yeah. Hi, good evening, sir, and hope all well at your end. So, sir, I just have a follow-up on the question that the first participant asked regarding the VNB margins on a, say, Q4 basis of this year to the Q4 basis of last year. So, as you mentioned that the margins are near to flattish only, but if I just compare the product mix might have changed quite a bit in favor of a higher margin products. So I'm just not able to understand why there wasn't some kind of margin improvement. That's the first part. And the second question is that if we look at the industry and the way our peers reported the numbers, there seems to be a lot of demand for high margin products, and that was very much visible in the NB margins for the fourth quarter. But that is not the case with, say, us. So just wanted to get your thoughts on how will the product mix look like, say, in the next couple of years, and what are the products we might, look to drive. So thank you. Those are the two questions.
Yeah, so basically, what we have done is, in my opening remarks, you might have heard that I talked about our Smart Platina Plus product, So we have introduced that product, which is a non-par guaranteed product, which gives income over a period of time. So that has been a very successful product, and we see, in March there was a huge uptake of that. And going forward, I think there will be a huge demand for that. So your point is valid that there is demand for high margin products if it is rightly, placed and rightly produced. So we have this beautiful product, and we are very confident that, we'll be able to do a good volume of those products going forward. Now, as far as the VNB margins being flattish and, the change in composition and all, we have to say that there has been a little, one of the other participants remarked that, the AP has degrown. So that is one of the components. The other component that we had repriced a couple of products, and so we had passed on more benefit to the customers, especially in the non-par segment. So and the annuity also. So all those things put together, I think it has remained slightly flattish. But if you look at it, it's not a small number. It is a good margin to have. 25.9% is not a bad margin to have. So to that extent, I don't think there is any cause for concern there. Going forward, we will get the benefit of having all these good products which have higher margins.
Just one follow-up, if I may ask. So you mentioned that we have passed on a little extra benefit on our non-par products to the customers. So the benefits that we are passing on, is it very different from the industry that we had to take this step? Or I just wanted to understand the logic behind passing more benefits in the non-par category. Is it because LIC might also get the very active in this space and we want to maintain our ground there, or what might be the reason?
No. Let me explain this. It's we always mention that we do adopt a very active pricing and dynamic as well. Now our objective is to grow the VNB and not much on the margin. So we don't believe that if margin is extraordinary but value is lesser, we'll achieve our desired number. So to that extent, what we mentioned that if yield has gone up significantly over the period, and we wanted, and hence our margin is going up, we wanted to give some benefit to the customer in terms of the higher return. And so rationalize our margin, but still margin is much higher than the we're looking into. So that's the reason we mentioned that we reprice and do that, because we want to be fair to the customer as well, that what return we are offering is reasonable to the customer. At the same time, you make the reasonable profit to the in terms of the margin to the company, and also achieve the reasonable sustainable value, and that will ultimately pass on the benefit to the company itself in terms of unitization of expenses, etc.
Okay, sir. All right, sir. Thank you, and all the best for the coming quarters.
Thank you.
Thank you. The next question is from the line of Jayant Kharote from Credit Suisse. Please go ahead.
Yeah, thank you for the opportunity. So I have two questions. One is following up on the previous question on the repricing. Was it done only in guaranteed products or protection products as well?
No, we have done in the guarantee product.
Okay. So basically what, after the repricing, it's visible that the margin accretion is not there despite the sort of pickup. So going ahead, do you expect that margins may not gain as much even if guaranteed product share moves up?
No, in fact, margin will, we are expecting the margin to further go up from the current level. What's happened that we introduced the product last time we priced in the month of April. Over the period 6 months, the yield has gone up. We are holding up the pricing on account of our distribution issue. August we have passed on, and if you look into the August till today, our yield has further gone up, and we are holding up this pricing. We are not passed on to that basis. So eventually we are going to gain more and more margin under perspective. Second part is we come out with another part what our MD sir mentioned on the non-par portfolio, which further going to aid the margin. So just to conclude, our non-par portfolio is going to be help us to accrete our margin from the current level.
Okay. Sir, and secondly on the FRAs, what is the pricing for FRAs based on currently, and do you feel there is adequate supply side? I mean, are there supply side constraints on FRAs?
So currently, we are, at least for SBI Life, we are not seeing any challenge in hedging, and FRAs we are able to do FRA within the pricing that we are doing. So whatever guarantee we are able to easily cover under the FRA rates we are getting in the market right now.
What is the pricing based on?
Meaning? So we have an assumption. What is the expected and what are the FRA expected rates also?
Okay. Sir, and the MTM hit because of FRA to our shareholders' funds on the debt side. So, I mean,
so there is no hit on the shareholders' funds.
So there's no, you see, we do the hedge accounting. Really. So any MTM gain and loss will routed through the hedge fluctuation reserve. So there is not a hit on the shareholder side.
And what would be our total exposure to FRA notional as of closing March?
We'll come back to you because I don't have a write down the number.
Okay. Thank you.
Thank you. Our next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Yeah, thanks for the opportunity. So in the VNB walk, you clearly mentioned that the methodology change improved VNB by 410 crores or 2.9%. So on similar lines, if because of the only methodology change, how much has EV got boosted either in rupees crores or in percentage? If you can explain, that will be very useful, sir.
No, Sanket, I do mention that we have done other changes. So if you look at the slide 32, we have given the other operating variance. That includes of that, and we are not having that exact number on that because what we did, we have done refinement in our model considering all aspects, and there are some several other minor refinement in the model as well. So we are not having that exact number on that perspective.
Okay, okay, sir. Sir, and second point is that in the operating variance number, other than mortality and expense and persistency, which is 12.2 billion rupees or 1220 crores. Do we have even factored in that Supreme Court related payback given to the State Bank of India to the policyholders, where we lost the case that 116 crores to be done in the current year, and probably second one is around 350 crores to be done in the next year if we lose it. So that number is also getting reflected in that particular number, sir.
Yeah, that's already been allowed for.
So you have allotted for both the products, or you just allowed for provided only for one product, sir? 116 crores.
Only for one.
That is 116 crores for the.
The other matter is sub judice. So we don't and there is no way that we have made a contingent liability for that in the balance sheet, and that's it.
And how much you provided, sir? My question is how much you provided in the current year for that?
116.
Okay, perfect, sir. Sir, the other part is that means two data keeping questions. One is what is your credit life protection business in the year or quarter, and second thing is that in annuity business. Just if you see the numbers in the fourth quarter, it moderated to 900 crores. It's just in AP terms, it is 9 crores, which is 13% growth year on year. So is this moderation is largely because you slowed down your business on group annuity, or you have seen that moderation in the growth in individual annuity too? And then if you can break down that annuity business into group and individual also will be useful, sir.
See, for the quarter credit life business, if I will answer the first one first. Credit life, for the quarter, we did almost 540 crores. And for the whole year, we have done approximately 1700 crores. Okay?
Okay. And on the annuity side, sir?
Annuity total, we have done both. I will give you separate numbers. Individual annuity, we have done 1780 crores. And group annuity, we did 1690 crores.
Okay. And so the slowdown was largely in the group business, sir, then?
Individual annuity is more than 40%. And group annuity, we are going in a flattish manner. Whatever we have assessed for ourselves in the budget for FY22, we have done.
And group, can you just tell individual annuity growth for the quarter, sir, for the quarter past away?
For the quarter, it was, I told you, 40% plus.
Oh, okay, perfect. And finally, sir.
Sorry, Sanket. For the quarter, it is 25%, 58%, sorry.
Individual annuity, right?
Individual annuity.
Oh, okay. And finally, sir, the non-par annuity business which we did 630 crores in the current quarter. Means you said that we launched a income version of Platina. So out of that 630 crores, what we have done in the quarter, can you break it down into income plan and endowment plan? I mean, just wanted to understand, and I'm under the belief that income plan will have a superior margin compared to endowment one.
No. Income plan was launched only in last week of March.
Correct.
So it was a strong start, but you will see the numbers actually in this financial year.
Yeah.
Okay, and is it safe to assume, sir, that income plan has a superior margin compared to endowment version?
Well, I think there is no such word. It's approximately similar.
Oh, okay, sir. Got it. That's it from my side. Thank you.
Thank you, Sanket.
The next question is on the line of Neeraj Toshniwal from UBS. Please go ahead.
Yeah, hi. Harping on the same question again on the 30.1 billion difference, if you can give more color on that will be helpful. As in, what led to such a big change?
No, I'm sorry, Neeraj, can't hear you properly. Can you repeat the question?
The same question again on the individual, on the EV change 31.1 billion. If you can elaborate more from where this difference is coming in, because this looks a little on the higher side. Ideally, it should have been maintained given we are already reporting effective tax rate numbers from a long time. So what offsetting change we are doing? That is not very clear till now.
Sanket, as you mentioned earlier as well, and I don't want to repeat, but again I'm repeating the same thing here again. So what's happened? We as a company report the base number that we believe at that point in time. And for comparison purpose, we do the effective tax sensitivity. Now we have done the appropriate modeling in our model to reflect the current tax positions and also consider the future tax position of the company. Accordingly, we have done that. And there are some other minor refinement in the model. We have done the comprehensive review of the model. And some places we required to make some changes. We did that, and unfortunately, we don't have that number to do the split because we have done all together in one moment and not.
So would this number be sitting in operating assumption change? I mean, the offsetting impact, not in the variance, in the assumption change, right?
Yes. So, Sanket, if you look at the slide 32, that number is sitting in the operating variance, other operating expense variance.
So operating variance is 12.2 that you have explained the effective tax, but the difference largely setting into operating variance or operating assumptions, because we have moved from gross to effective tax rate. So how to look at it? I mean, so the operating ROEV, actually getting to operating ROEV, would that be lower and look optically higher for this quarter? I mean, how should one read into that?
No, operating assumption change is not reflected there. So.
Okay. And what is this? If you can just give the 4.5 in economic variance movement debt in the equity and because change in yield, how should we think about it for the, because yields are still increasing? To have the split?
No, so basically we look into the what is the reference rate, discount your WIP, and then you look into the what is expected real world rate on your getting and difference. So basically, unwinding will be done on the real world return basis. So
no, not on the unwinding. The economic variance I'm talking about.
Economic variance is exactly the yield curve says, nothing else. Nothing else. Sorry.
Okay. And on the new product which we just launched, can you give more color? I mean, it's a similar margin, but what is the strategy going on in terms of growth? What we can expect in terms of VP in the current environment? Are we looking to change, alter our mix with a lower ULIP and higher traditional? And within the protection, the growth has been quite good, but have we able to manage to improve ROP and term mix, or it has remained largely stable?
See, first thing is that the product mix, we foresee that we will have more non-par products being sold. Protection, as you can already see, is very strong. We have grown protection by about 26% this year. So, which is very much in line with, all the other growth, of all the products. So protection also has also grown by 26%, and we think this trend is sustainable. And like I said, non-par, we have now a good portfolio with 3-4 strong products, and that will also grow. So obviously margins are going to grow, and the product mix we think will shift. It's not a conscious effort on our part to reduce sale of ULIP or something, but these products are seeing a good demand, and they will definitely, the higher margin products are selling very well. As we have said repeatedly, that our ULIP products are positive margin products, so we are not losing anything out there, and we will continue to sell if there is demand. So as long as there is customer demand, we will continue to sell the ULIP products also. And I think, the persistencies in ULIP are excellent, and they are likely to continue that way. It gives a lot of liquidity and flexibility to the customers. So ULIP, we don't see ULIP being discouraged by us. It will depend a lot on the customer demand. But like I said, the trends are that we will have more non-par guaranteed business in the mix, and also more protection. And as far as the question of improving to pure protection, I don't think that is a right question, because TROP is a very good product for the customers, and it gives the similar value and good protection. So I don't think we are consciously trying to shift TROP customers to pure protection or anything like that. But pure protection has its own challenges today, with a lot of reinsurance and all issues coming up. And, as things ease out, I'm sure that pure protection will also be sold more. But then, not because I want to sell more of pure protection, but because, the demand is there, and we will be able to sell more pure protection. Having said that, I don't think we are going to discourage sale of TROP. It is a very good product, and I think it is an excellent product for people, especially, the not very educated people and the people in the B towns, etc., and also the let's say the middle class people also. It is a very, very, very good attractive product.
That is helpful. Only if you have the split handy between within the pure protection in the RP and the term pure play.
Yeah, that is the same. It remains about the same. Every time we say it's the same thing, 85-15 approximately.
Okay. And on the credit protect attachment rate, are we seeing improvement?
Yeah, it has improved from 46% last year to 50% this year, and we can see trends that it will go further up.
Great, thank you, and all the best.
Thank you.
Thank you. Next question is from the line of Aditya Jain from Citigroup. Please go ahead. Aditya Jain, your line is unmuted. Please go ahead with the question.
I'm sorry. On the VNB bridge, so there are various components there. There is no specific component which talks about benefit of operating leverage. Just because of the size increase, there might be some margin expansion. So is it that we are not seeing that, or is it that it is built into some other component?
Which slide are you talking about?
No. See this, when we do this, our assumptions for the VNB computation, both the initial acquisition expenses as well as maintenance expenses, that truly reflect our current year things. So we realign each year, and that already inbuilt in this process. This is not that we use some long-term assumption which is not reflecting our actual positions. So already built in that.
Okay. So what is the right operating ROEV to look at going forward? The 20.6 number, does it apply going forward as well? I mean, roughly.
If you see the historically our operating ROEV is in the range of 20%, so we'll continue to look into that. And as we mentioned in the earlier call as well, a different question that your assumption is that and we're getting parity variance. If that will play out, I think there is a scope for further improvement from the current level.
Sorry, the full year margin of 25.9% VNB margin. Would this be lower in the new pricing method? So the new pricing, as I understand, came into effect in more recent quarters on the non-par side. This 25.9 to a large extent is reflecting old pricing, therefore. So
no, it's a part of, see, what we said was that there are a lot of factors including a little bit of price change, not directly contributed entirely by that. And going forward, like we have said, that this is a higher margin product, so it is going to contribute to the growth of the NB margin.
But as a starting point, is 25.9 the right number to look at, or would this be lower?
No.
On a new
exactly, 25.9 is the right number to look into this. There is no different two number. It's only one number. 25.9 is the right number, and you can look into the margin accretion will happen from the current level. So going forward, you expect, because the reason that we are going to sell more and more non-par product, obviously because there is a demand and we introduce new product. We are also coming with the deferred annuity on the individual product. So there will be more bouquet of the non-par product in our portfolio, and that will help us to increase the proportion of non-par, and that will ultimately help improve the margin from the current level.
But just lastly, talk about the change in margin because of the pricing change specific to the non-par product, if it's possible. So in the non-par product, how much it changed from X to Y? So what is the delta of?
No, we are not. Basically, we are not disclosing details of margin, etc. There are a lot of products. There are a lot of versions where the pricing is all different and the margins are different. So we are not giving any figures out, but suffice to say that these are higher margin products, than the company's margin today. So obviously, if it increases in percentage terms, it will contribute to the increase in margin.
Got it, sir. Thank you.
Thank you. Thank you very much.
Thank you. Before we take the next question, we'd like to remind the participant to limit a question to one per participant. If time permits, you may join the queue for any follow-ups. We'll take our next question from the line of Hitesh Gulati from Haitong. Please go ahead.
Yeah, thank you, sir, for giving me the opportunity. So, on operating assumption change, is there a negative mortality assumption change also included there? And also, so could you give me the exact COVID claims impact before tax for this year?
So Hitesh, this operating assumption change is mainly on account of the mortality and morbidity assumption change. It's a very not significant thing because we have tightened last time. So this is the one part. Second question to on the COVID one, if you look at our mortality variance, our COVID claims that we just mentioned is around 1,500 crores net of reinsurance, and our operating variance on mortality is coming 10.8. So other than COVID, we make a positive mortality variance. COVID has led down us to give some negative mortality variance.
Okay. So 1,500 crore post-tax would be about 1,350. The impact is 1,080. So there is a delta there, right?
Sorry, Hitesh, I'm not getting your question.
So 1,500 crore is COVID claims. Post-tax, that will be about 1,350 crore, right?
See, no, we should not look into that.
Yeah, we don't calculate
what we should look into that what is the expected claim that you are looking for and how much you paid for, correct? And then tax will applicable only on the if there is any positive variance coming on that perspective. So claim is not look into the net of taxes. Claim is always look into net of reinsurance, not net of taxes.
Okay. And sir, mortality assumption change is only 10 crore, or is it a bigger number offset by a positive number?
No, it's only this number. With this, nothing, no other changes. So this is purely on the mortality and morbidity side.
Okay. Thank you, sir.
Normally we are making mortality profit, so no point of extending this assumptions.
Right, sure. Thank you, sir. That's it from me.
Thank you, sir.
Thank you. Our next question is from the line of Abhishek Saraf from Jefferies. Please go ahead.
Yeah, hi. Thanks for the opportunity. Most of my questions have been answered, sir. Just one follow-up on ULIP side. So one of our peers had mentioned that in ULIP there is some changes happening in terms of the products that are being demanded. So more tilt towards debt ULIP rather than equity, given the volatility in the market. So are we also witnessing that kind of change in customer behavior?
So right now we have not witnessed any drastic change. But what does happen is that I think somebody's phone is on. Yeah, okay. So we have not seen any drastic changes there. However, in the past also, when markets have been down or have been too volatile or something, customers have opted to switch to more debt than more equity. So that kind of thing we also expect that can happen if there is a sudden drop in the market or something like that, if sudden changes are there. Similarly, when markets are going up, there is a demand for equity also. So that is there, but we have not seen any significant shift right now.
Just on this, so if you can help me understand this, what could be the margin difference between a standard debt-heavy ULIP versus an equity-heavy ULIP?
Very difficult, we may have those figures somewhere, but I don't think we want to share those.
Thanks for that. And lastly, on a non-par guarantee, so given that yield curve is kind of flattening, so can you help us understand the spread that we would be locking in the current product versus the earlier product, given that we have also had repricing for our customers?
So just to tell you, currently we are still able to get FRA rates which are better than what we have budgeted when we have priced the product. Now, if that changes, we will reprice the product.
Then is it fair to assume that the spread would have been largely been maintained?
Yes.
Sure. Thanks a lot. If I can slip in last question, sir, if you can help us understand, given the trying to change it the way it made and being a bit aggressive on non.
Your voice is
I think
breaking.
there is some. Yeah, your voice is cracking. Can you?
Please use the handset mode. Thank you.
Sorry about that. Is it better now?
Yeah.
Yeah. So sir, I was just asking that on the impact of LIC changing the way it does business and being aggressive on the non-par guarantee side, and also kind of pushing other products which it had not been present in, be it ULIP or protection. And so are we kind of missing any of these at the ground level? Is the competition changing for us as well?
We have a huge distribution network, which is, not dependent on LIC doing well or otherwise. So, we have the banks with us. We have SBI, we have many other banks, almost 75 banks, of various sizes we have. And apart from that, we have 146,000 plus agents. And then we have many other partners, brokers, corporate partners. So, given that distribution strength, I don't think we are looking at, any other player getting more or, becoming more aggressive or anything, because we have our strengths, we have our good products, and we have, been able to grow year after year, even in the pandemic, even in bad situations. So I don't think that we are worried about that or that it is going to affect our business.
Sure. That's very helpful. Thanks a lot. That will be all from my side.
Thank you.
Thank you. Our next question is from the line of Dhaval Gada from DSP. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. I had two questions. Sir, if you look at the difference between the EV on statutory tax rate and effective tax rate in FY21, that was close to 3,000 crore. If you look at that same number in 1H22, that was 3,200 crore. I understand that you've given an explanation for 1220 crore on the operating variance others, and then within that there is also one more adjustment of 116 crore. So if I add that, it adds to about 1336 crore. I'm just not able to reconcile the balance. What are the adjustments? Because the residual number is quite material. So if you could just break down what are the major, buffer or provision that you've created to reconcile the number. So that's the first question.
Yeah. Let me try to respond to this question on the way that you're looking for. One is that we should not look into the September number for effective tax perspective, because the tax will look into the entire year and longer term perspective. Now, as I mentioned that we are looking to in the current number that we have disclosed, and we're going to disclose this way in future as well. We have looked into our current financial tax position. We also projected out, and based on that we do the modeling. There are some other elements, because as I mentioned, we have done the comprehensive review and some of the models, so there will be some offsetting impact towards that. And unfortunately, we are not having that exact number, the tax, because if you have done only for the changes in the tax, we do that. If you have anything, we can take offline as well. But as of now, since we have done several other changes in the model, along with the tax, predominantly the tax, we are not having that number separately. If you have done only the taxes, then it's easier for me to give that number to you. So that will be not.
Sorry, but if you could just qualitatively help us understand what are the areas where major changes have been made, that would also give comfort in terms of where the residual amount has gone. Because I mean, even if I look at FY21, the difference between the two methods was 3,000 crore, and that's the reason. So I'm not looking at September 21, September number, but just the March number last year. So that's.
Can we take this offline?
Sure.
If
Okay.
because we don't have that number, we can take it offline anytime.
Okay, we'll do that. And sir, the second question is on the mortality side. So the 1080 crore, if you could just help us understand. So at the start of the year in 1Q, we had created about 445 crore of extra reserve on top of our March number in terms of mortality reserve for COVID. And then September, I think we were comfortable with the level of reserve. December also we were comfortable. So this 1080, should I understand that this was largely created at the end of the year to sort of see the past experience as well as what we are likely to see in future? So just trying to understand the initial sort of guidance around 445 to 1080, how the reconciliation is. So that's the second question.
No, let me explain this. This 1080 is the actual claim that have been paid over and above the provision that we made of the year. If you remember, beginning of the year we make a provision of 183 crores, and our COVID claim received was 1500 something crore net of reinsurance. So this is the shortfall coming from that perspective, and on top of we make some normal mortality profit. So that's the number is. This number is not about the provision that we are carry forward for the future.
Okay, fine, sir. Thanks and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Hi, sir. So again, at the risk of repetition, can we have the slide 32 walk from 364 to 396? Now, 364 plus 37 and plus 27, these are like unwind and VNB. That's very, very clear number. Now, from 428 to 396, this 32 billion, out of that again around 7 billion is explained by economic variance and other. 25 billion number has to come from operating variance. And now because it's not assumption change, it is about variance. So this has to be explained. And there is of course a big hole, and that too basically variance means what you experienced was different than your assumption in the previous year. So that's a big number. I mean, so what it is, I mean, this is not sort of adding up.
I think we have explained this quite a few times in this call. In detail, that I mentioned that all other, if you look at slide number 32, we explain other variants. So that's the reason we put this method change and other changes all together is 12.2 crores. So there is some other offsetting impact on that perspective. So that's maybe not able to reconcile that number. If required, we can take this discussion offline. We don't have that each and every step level number available that we can tell to you.
No, sir, it's variance, just like 1 year experience versus assumption, and it's a big number, sir. I mean, you have put on a mortality, you have put on a smaller number, but this bigger number is not, adding up. So I mean, how to sort of go about it? I mean, 364 to 396 is what walkthrough I'm asking for.
See this, when we're making any change in the taxation or any other methodology, the methodology impact is not only for 1 year, it will be for the future year as well. Agree? So if I look into the impact of any changes, because when you project your future profit and even a tax or any other variant you apply for each future year and discount it back. So point of time to make it this impact is not only for 1 year that this is happening. I'm not sure whether I'm able to convey. If there is a question, we can take offline on that perspective. I will be more than happy to explain to you.
Thank you. Our next question is from the line of Nishant Chauhate from Kotak Securities. Please go ahead.
Yeah, I'm just looking at slide number 13, and this is on change in operating assumptions and economic assumptions. If you could kind of help us understand what is this on account for.
Just 1 second. So this, if you see this V1B, the economic variance is purely the economic variance. 0.9 is just yield curve impact, nothing else. And other operating variance is 0.8% that we showed 119 crores. This is predominantly the mortality and morbidity assumption change.
Sure. Got it. Thank you very much.
Thank you. Our next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, thank you for taking my question. So can you give us some sense of your margins in different segments? So, let's say protection, non-linked savings, what could the broad sort of margins be of there?
So we have not been actually, we are not we are not disclosing the margins in absolute terms. We can say that term protection has got the highest margin, and then term with return of premium and non-par guaranteed, and then ULIP. So that would be the way to look at it.
Okay, so can I get some sense on what are the linked margins now? So in the linked business, how different would we be from the company average? Hello?
Yeah, so linked, I think it will be around 15%, let's say.
Okay, got it. And so what, I don't know whether this was asked earlier, but it seems, in Q4, the growth is slowing down, and so I want to get some...
I have already explained, Q4 growth, especially January, February was affected because January there were some severe lockdowns in some places, and that did affect the business. And then February also, it didn't really bounce back, but we did almost what we did last year. And then in March, we again started seeing the growing trend.
Right. And what do you think? What do you think? Now we are at a pretty high. So looking into FY23, 24, what sort of growth do you think we can aim for? Or do you think the growth will weigh down?
We are targeting numbers which we have done before. So similar numbers we are targeting this year also. Base effect, I know that there could be a base effect normally, but then with the potential that is available, we are targeting for the kind of growth that we have witnessed in this year. So now that is the way that we are going to go.
Right. And last question, sir, you increased the guaranteed return on the guaranteed product, sometime in August you mentioned. And again, obviously interest rates have gone up, so the margins are getting better. What drove that decision? Do you think it's competitive intensity that competitors have started passing that on? Is that what is driving us also to do that? And are we seeing that sort of behavior again play out right now?
No, see, when the rates of interest go up in the market, obviously the expectations will also go up. So, we have to keep a fine balance between making margins for ourselves and also, giving the customer a good product. Now, whether that is driven by competition or not is a moot point, So what happens is everybody is driven by the same considerations. So if there is an increase in the interest rates in the market and you don't reprice, then obviously, your product is not going to be very attractive. The second thing is that we are banking on volumes. Now, if you will see that our growth has been huge. So we have had 26% growth last year in APE. So 26% growth means that, with a constant margin also, I keep making more and more money for the stakeholders.
Got it. That's it from my side. All the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
So what I wanted to understand is that on a long-term basis, what
there's so many accounting adjustments that, for a lay person, it's difficult to understand the economics of this business. So, when we look at banking, we'll say banking is like a 15 to 18% ROE kind of business. How do we think about, on a, say, normalized product mix basis, what is the ROE of life insurance?
See, let me tell you, it's not a very simple question to answer because different companies have got different products that they sell. Suppose I was a company selling only term life insurance, I may have a much higher return, okay? And if I were a company selling only ULIP, I may have a different return which may be lower. And the product mix is generally dynamic. The margins of products also change. So today what the margin is that I'm receiving on a par product may not be what I get tomorrow. So every quarter I'll have to look at that. So it is not very easy to say, life insurance as such. So, every year we take targets and they take these targets based on our business expectations, So what we do is we first start with what is the demand that we are seeing for various products, and then what are our competitive strengths in those products, and then we decide that this is the amount that we will be able to sell. And then once we budget for that, after that we work back and get all these things, your ROA, ROE and all those things come out of our business assumptions. So every time it's going to change. It's not that if I make business assumptions in March, I'm going to stick on to that, hang on to that for June quarter or for, the next quarter, September quarter or December quarter, because I will keep analyzing. So it's not very easy to say that. So I will not venture into that. It is very dynamic.
Well, sir, I'm sorry, I didn't understand you. My question is that let's assume that you are only selling term protection. It's a hypothetical scenario. But if you're only selling term protection over, say, the next 5 to 10 years, right, what would have been the return on equity of a well-run life insurance company that is only selling term protection?
No, so this is a slightly hypothetical question. So let me go one by one. So first thing I want to tell you is that unlike, some of the other financial services business, I know that our AUM has gone up from 10,000 crore or policyholder liability, whichever way you want to look, to, almost 2,65,000 crore without single rupee of dilution of equity. Correct? Our only equity dilution has come from ESOP. So completely internally funded growth, which is not true for a banking or NBFC. So now when you can't compare it on that very first basis, because if you see when we have been growing fairly well across the years, AUM growth will be 18-20% every year when you take a 10-year CAGR. Now our accounting, because it's a long-term product and you have to have that new business strain, there are some challenges around, how you look at it. So once the new business strain eases and our growth comes down to tepid, I don't know when that will happen, 5, 10, 15 years down the line, 5% type of it, then the accounting profit that you will see will be very similar based on year-on-year number because of the past books that will. And I would not expect, if it's a well-run company, why should we make less money than other financial services business?
Okay, sir. My second question, sir, is that if one has to, again, as a broad thumb rule, assume that the accounting policy was such that one could amortize the customer acquisition cost through the life of the policy rather than the first year new business strain, then how much would, say, your reported PAT roughly increase by?
This is a hypothetical question. I think this is not allowed in India as well in terms of the amortizing your acquisition expenses. As per the Indian regulatory and accounting environment, you have to do this. So we have never done that approach in India to see that what is hypothetical and do that.
So there are two things, not only acquisition equation amortization, but that margin for adverse deviation also has to be kept. So there are two factors which depress the profit when you are doing accounting. that number would be significantly higher than the accounting number that you are seeing, 1,500 crore of profit that we have declared. That you can be, quite. And now, to say that our net worth is, let us say, 12,000 crores, and if our profit is whatever, I will not give you a number, if some number higher than 1,500, then you can do your own ROE calculation.
Thank you. Our next question is on the line of Rohan Advan from Multi-Act. Please go ahead.
Yeah, thanks for the opportunity. Sir, if you look at our AP mix, Q4 FY21 versus Q4 FY22, our ULIP share has gone down from 70 to 63. Individual non-par has gone up from 8 to 15, and protection group plus individual has gone up from 6 to 9. So we've had a very favorable product mix from a margin perspective. Even then, margins have gone down from 27.7 to 26.9 using effective tax rate for both years. So could you explain what has happened here, and was there any one-off possibly in the base quarter of Q4 FY21, because those margins seem very high and those were possibly not comparable to the natural trend that we have. So can you just throw some more light on this, because in a context of a very favorable product mix from a margin perspective, our margins seem to have dropped.
So our AP has gone down, like I said, one of the factors is that the AP has gone down quarter to quarter, if you see, by 4%. So that is one of the reasons there. The other thing, like I said, the repricing of the non-par product also. So that was one of the things which, even though the non-par percentage went up, because we had repriced it very, looking to, the increases in rates that we were anticipating, and the interest rate has behaved exactly like that. And so as a result of those, I think all these factors have gone into this being flat.
Okay. Sir, and going forward, do you expect our absolute VNB growth to track AP growth, or there should be some margin expansion kicker in the future?
Margin expansion will be there. Margin expansion will be there. That is what we feel. I can't predict what will happen exactly, but then we feel that margin will go up, because right now, like we say, last time also when we changed the pricing in August, before that we had a very healthy margin on that, and that is why we thought that looking at the market and the way the interest rates were looking likely to go up, we wanted to reprice the product and get volumes out there. We have been able to start getting volumes there, and we have introduced another product. That has proved to be quite popular in the end of March. We saw in the first 7 days, 10 days of launch itself, we had a good number. So going forward, we think that these products will continue to find traction. The other thing is, of course, our focus on protection. So when protection grows at the same rate as the entire business or higher, then the margins will go up. So looking at all those things, our margins are likely to go up.
Thank you.
Thank you.
Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Mahesh Kumar Sharma for closing comments. Thank you, and over to you, sir.
Yeah, thank you very much. It was great spending the evening talking to you and getting your feedback and also your questions. Some of you whose questions have not been answered in full, I'm sure Pritesh will be very glad to sit with you and talk to you about all those assumptions and all the changes that we have, so that all these doubts can be cleared. Thank you very much for participating in the call, and I wish that all of you stay safe and healthy and have a very nice evening. Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, on behalf of SBI Life Insurance, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.